Howdy y'all, and welcome back to the Texian channel. This is episode 1, The Problem with Corporate Share Buybacks. So what do we mean by a corporate share buyback? What exactly is that? Well, the technical term for it is open market repurchase. Alright, so what that means is, a company has taken its capital, taken its money, and gone out onto the stock market and bought it back from whoever currently owns it. So, just like you and I can go out onto the market and buy the stock, the company can do the exact same thing. Now, companies attain their capital in really one of two ways. They can lever up, which means to take on debt, basically, or they can use what's called their free cash flow. And free cash flow is a finance and accounting term to describe the amount of money that's left over in the business after they've done all their, paid all their bills, paid their interest, and paid their tax. So you take your revenue, you subtract all the expenses and the costs that you have to generate that revenue. That leaves you with EBIT, earnings before interest and tax. And then you'll pay your interest, whatever obligation you have for your interest, and you'll pay your tax, whatever obligation you have there. That'll leave a number, and then you'll add back your depreciation and your amortization if it's appropriate, and whatever's left there is called free cash. And it's basically just the money that's left over and what the company can actually go and set in the bank, just like you and I would deposit our paycheck in the bank. So now that they've got that capital, they can really do 4 things with it. Now, there's a couple others, but for the most part, there's really 4 things that they think about doing with it when they sit in these meetings. Number 1, they can put it in the bank and earn interest. So just like you deposit in the bank sees it as just another deposit that they have to pay interest on, and they'll pay interest to that company, just like they would pay it to you and I. Number 2, they can de-lever. They can pay off debt. So that means taking long-term and short-term liabilities off the balance sheet and with the cash. You could think of that as a corporate bond or other money that they borrowed some other way, or maybe an accounts payable that they need to clear up for one way or another. Anyway, basically they can take some of the debt and some of the obligations they have off the business. 3, they can invest it in new product services or growth initiatives. They can buy a new plant. They can buy, I don't know, they can use the capital for just about anything they want to grow the business at that point. Invest in R&D. Hire more people, expand to a new location, those types of things. Option number 4 is to buy back the company's stock, which is what we're talking about today. Not surprisingly, option number 4 has become incredibly popular here recently, and the problems that poses to the economy is what we're going to talk about. So let's talk about a little history first of corporate share buybacks. It hasn't always been legal in the United States. In fact, the 1934 SEC Act, I should stop here for a second. It is exceedingly rare, in my opinion, for the Congress of the United States to pass a truly excellent piece of legislation. But in my opinion, the 1934 SEC Act and the Banking Act of 1933 were absolute gems. They were outstanding pieces of legislation that served us very well throughout the bulk of the 20th century. They were passed by people who had just gone through the crash of 1929. It was the height of the Depression. They were the result of congressional testimony of many average, normal people who had lost everything in the markets, and they were determined not to have that happen again. And they passed the 1934 Act, which created the SEC, created some rules, and has served us awfully well since then. Now, the Act itself didn't make it illegal to buy back stock, but what it did say is you don't have any protection from market manipulation if you do. So buying back your stock is a form of market manipulation under the SEC Act. And what they basically said was, we're not going to give you any protection from charges of market manipulation if you do it. And without that protection, companies for the most part shied away. They didn't want to get in trouble for doing it, and they could get into a lot of trouble. And that changed in 1982 when President Reagan and the chairman of the SEC, a man named John Shad, passed Rule 10b-18, which gave that safe harbor protection to companies from charges of market manipulation. So basically it said, go ahead and do it, and we'll protect you. Now, it should be noted that John Shad worked for a company, I think it's E.F. Hutton, I'm not sure. Haven't done the full research on that. But the company that he worked for would directly benefit from the legalization of corporate share buybacks. There was a clear conflict of interest. And unfortunately, as our government often does, it was more than happy to look the other way and pass this thing, which directly benefited him. Now, there were some rules. It wasn't a total free-for-all. Companies couldn't buy back more than 25% of the volume that had traded in the last 4 weeks. So in other words, they'd look back at the last 4 weeks of stock trading and whatever the average was per day over that period, a company couldn't buy back more than a quarter of that number in any given trading day. And they also couldn't open the day or close the day with the repurchase of the stock, because it would cause, it would be a pretty big manipulation. If the company comes in right at the opening bell, buys a bunch of stock, that's going to send a signal to the people on the trading floor and to other people in trading to buy in as well. And so they didn't want to have that manipulation, and so that was illegal too. So let's illustrate this. What do I mean? So let's take company A, just random company. Let's say per day over the last 4 weeks, 1,000 shares of that company get traded by people, back and forth, 1,000 shares. What the law meant was company A could only buy back 250 shares in a single day, and they couldn't start or close the day with that purchase. All right? So it makes good sense. It's pretty easy, and a decent way to prevent them from absolutely going insane with this. But not unsurprisingly, since 10b-18 was enacted, stock repurchases have exploded. It's really become the go-to thing for corporations to do with their money. And I'm going to talk about that a little bit as we go further on into this video. But just understand that this rule was a boon to the investment banks. It was a boon to the corporations. It was a boon to people like John Shadd and others who worked in this industry. They've been wanting this for a long time, and they got it. And it's been to their benefit, and I would argue personally, to our detriment ever since. So, why do companies choose stock buybacks? Well, simple fact of the matter is it's really the best option of the four. Let's take a look at them. Number one, you could put it in the bank and earn interest, right? Well, interest rates are real low. So your return on capital is very low there. You're going to get very little yield back. You can pay off debt with it. But again, interest rates are low, meaning the money that you've borrowed is very cheap. And by paying it off, you're actually not saving much. You're not taking that money and really generating a lot for the business by doing that. It's certainly not a bad thing to do, but it doesn't really help the business immensely. You can invest in new products again, but that's risky. And, it's risky even in the best of times, which we're certainly not in, by the way. And oftentimes the return on that investment, the payback period, as they call it, or the DCF if you want to look at it that way, is years off. 3 to 5, maybe as many as 10. And a lot can happen in 3 to 5 years, especially nowadays. Things happen in 3 and 5 hours nowadays. But suffice it to say that it's risky. Real risky to do, number 3. Number 4, on the other hand, is no risk. Basically, you can go out and buy back your stock. And typically, when you do it, the stock price is going to go up afterwards because it's simple supply and demand. You've taken stock off of the open market. Therefore, there are fewer shares to trade, same amount of money chasing after them, price goes up. So there's very little risk, and it's also very high yield, certainly compared to the to options number 1 and 2. So you're going to get a much better yield than putting it in the bank. You're going to get a much better yield than paying off debt with it, and you don't have any of the risk that you'd have if you wanted to invest it. Therefore, companies make a pretty simple choice. Go with option 4. So why is it a problem? Well, simply put, capital that should be going to grow the economy, that should be invested in option number 3, in R&D, new products, new services, the things that we want corporations to do with their profit to help grow the economy and create better opportunities for normal people, capital's not going to that. It's being tied up into these transactions. For the 449 publicly listed companies in the S&P 500 between 2003 and 12, 97% of profit went to shareholders, with 54% of that used for repurchases. So think about that. Almost everything the company made went back to the shareholders. Wasn't invested, wasn't put towards new property or equipment, wasn't put towards a new product or service. It was given right back to the shareholders. And half of that was for repurchases, is the way that they got that money back. So not just a direct compensation. We'll talk more about why they do that. But nonetheless, 54% of all that money was, or that profit being returned to the shareholders, was done through repurchases. And of course, that's capital that could go elsewhere and do better things, like hire more people, grow the economy, innovate something new. Here's another stat. In 2018, only 43% of companies in the S&P 500 had any R&D expense at all. 57%, over half, didn't invest in R&D at all. And 38 companies accounted for 3/4 of the spending on R&D. So really, you only had 38 companies out of 500 in the S&P putting any money towards R&D at all. Now, R&D is just one portion of that. Obviously, there's other things you can do to invest to grow. But it's indicative of their mindset, I think. They're willing to sacrifice R&D investment and really put it all towards buying back their stock. There's no other thing they could do with it. What's even worse are companies are levering up now, taking on debt and then buying back their stock with it, which causes a whole host of problems. The proportion of buybacks from corporate bonds was 30% in 2016 and 2017. That's a high. 30% of all the buybacks were funded with debt. Think about that. No free cash was being used. Or they were using their free cash and borrowing on top of it, which just makes the problem even worse. Of course, that makes their balance sheets look better than they should. And that's not good. It gives a false impression of the health of these companies. And I love this quote from Senator Warren of Massachusetts. Give them a sugar high. It helps their earning per share. It makes the earnings per share look far better than they actually are. And in fact, they can do this, and we'll talk about this a little bit more later, they can buy back their stock in an effort to hit some of those earning per share targets. So when they know they're going to miss, they can use this mechanism to make sure that they hit their compensation goals, the executive team, that is. We'll talk about that in a second. But nonetheless, it gives a false impression of the health of the company. The earnings per share isn't what it's saying. It's just been manipulated to that by taking more shares off of the market. It's, the old numerator-denominator phenomenon. So why is this really a problem? Well, CEOs and other executives basically can give themselves a pay raise by doing this. Most of the compensation for executives now is done in corporate shares, is done in stock. And there's a reason for that. If you pay them in cash, they have to pay the tax on that cash as income, meaning 37% or 35%, whatever it is. They'll also have to pay any state income tax that goes along with that. However, if you give them their compensation in shares of stock, they only pay tax when they sell it. And that tax will be the capital gains rate of 13%. Now, I live in Texas. I don't know if there's such a thing as a capital gains tax at the state level. There may be. I'm not sure. There's not one here, thank God. But anyway, these executives can use this as a tool to give themselves a pay raise on the back of the company. As I said a minute ago, they can also use it to make themselves look better and achieve their compensation targets. If they have a certain goal for earnings per share or a certain goal for profitability, they can use this mechanism to get there when they otherwise wouldn't. So Rule 10b, the one that we just talked about, gives executives total power to determine their own incentive-based compensation. And that's basically what I just said. They can basically do whatever they need to do to hit their targets. Here's a good example. And I don't mean to pick on Steve Mellenkopf here, but this is a good example that I found. In 2018, Mellenkopf received total compensation of $20 million. The year before that, it was 11.6. It went up $9 million, or right on 50%. Of that, of his total compensation, 86% was earnings per share related to one extent or another. So what does that mean? What that means is how he got compensated was a direct result of how the share price was doing. And as I said a few minutes ago, buying back corporate shares is one way that you can help that, make it look a whole lot better than it is. So it allows these CEOs to manipulate the markets and manipulate their company's stock to benefit themselves. And Steve Mellenkopf is just one example of that. Love this quote. Empirical analysis of firm behavior has revealed that the likelihood of repurchases, that's stock buybacks, is higher at firms that would have just missed analyst earnings expectations without the effect of the repurchase. So stated differently, when they look at it, the likelihood of them buying back their stock is higher if they would have just missed their earnings expectations. So in other words, these executives get in a room, they look at the numbers, they realize they're not going to hit the targets that are going to give them their compensation packages, and they say, well, what are we going to do about that? Well, here's one thing you can do. Here's one thing you can do to make sure you get that compensation. If not in that year, maybe in the next year. So probably one of the most esoteric parts of this is that they actually increase wealth inequality. What happens when the price of a stock goes up? Well, the people who own the stock get wealthier. Not only do they get wealthier, but the people who don't benefit from that are priced even further out of ever even owning that stock. Right? I can't go buy a stock if it goes up a certain number of dollars, a certain amount. So the people who own them get richer. The ones who don't own them can't buy into them. 2 videos from now, I'm going to do a video on wealth inequality where I talk about that very same thing. Asset bubbles continue to repress young and low-income investors, as the bottom 50% now only own 0.8 of the stock market, considering the appreciation of asset prices, with stocks and housing being the main culprits. So we create asset bubbles when we do this thing. We pump a bunch of liquidity into the stock price and drive it up. Good for the executives. Good for people with a 401k, to be fair. But not good if you don't own it, and not good if you want to try to buy in. Stock buybacks have been a prime mode of both concentrating income among the richest households and eroding middle-class employment opportunities. He's a UMass Lowell professor who studied it. I think that's well said. It's a prime mode of both concentrating income among the richest households and eroding middle-class employment opportunities. They take the capital, they put it into their pockets by way of the share buyback, and it doesn't go into growing the businesses that would benefit middle and low-income people. Barely 1/3 of families in the bottom 50% of earners own stocks. And we're talking about that, right? Really, it's only the rich people that own it to begin with, either directly or indirectly, meaning through your 401k or through a managed account, or an account that you own with Ameritrade or whoever it might be. The average portfolio among this group is worth about $52,000. By contrast, the Federal Reserve Bank, said 93%, call it 94%, of the top income group owned stocks in 2016. Their average holdings stood at 1.4 million, which is up from 999,000 in 2013. They're getting richer off of this. The more they can drive up their company stock, the more money they make. That's why they do this. And it has huge impacts and huge downsides to those of us out in the real world hoping to see the economic growth that we need to have more opportunities and aspire to something better. Now, I'm a fan of tax cuts. I'm a conservative, like I said. But those tax cuts, number one, have to be offset with spending cuts, in my opinion. And what we did in 2017 has only made the problem worse. Basically, 2017 and the tax cut that we gave corporations poured more gasoline on an already raging fire. It gave them even more free cash to use because they didn't pay as much in tax, so they had more money. It gave them more money to use to do this. And again, they took a look at those 4 options and said, this is the best place we can put our capital. We're not going to invest, we're not going to grow, which is the goal of these types of acts and these types of tax cuts. I said, no, we're going to buy back our stock. By mid-December of 2018, following the corporate tax cut that was supposed to help the middle class, America's public companies had announced $1 trillion in stock buybacks, with $800 billion already repurchased. Think about that. $1 trillion in stock buybacks in a single year. Now, why did they do that in 2018? Because that was the first year that they actually had the tax cut in place. They had all the extra money. It was a record year by any standard. The $370 billion in repurchases, which the S&P 500 companies did in the first half of 2019, as the last, the articles I found, that was kind of the last bit of data I could find on this, is on pace for total annual buybacks that are second only to 2018. So basically, we're on track for a new record, or we were in 2019. 2020 data is not out yet, at least I couldn't find it. If you can, comment below and let me know. I'd like to know how the numbers actually turned out. So what's the solution? Well, I think there are a couple of options. We can make corporate share buybacks illegal, in quotes again, meaning take away their safe harbor protection from doing it by repealing Rule 10b-18. That's one option. Now, it's important to know that that's going to have some consequences, right? Everybody that has a 401k is going to feel the hit there because stock prices aren't going to go up artificially as they have in the past because of this phenomenon. So you can expect the 401k to fall. And that will have implications for things like public employee pensions and a lot of other organizations that use investing in the stock market as a way to make the money they need, whether they're I don't know, a municipality, a city, or the teachers union, for example, or CalPERS, or whatever it might be. They're investing their money in the stock market as an effort to be able to make their liabilities to their employees, or to the union members, as it were. So by doing this, we risk that. We risk, a lot of municipalities not being solvent. We risk some of these employee pensions and things like that looking a lot worse because they're just not going to have the capital that they would have before, because they're so reliant on corporate share prices to go up to do that. And of course, your own 401k, especially if you're retired and on a fixed income, is going to take a big hit. It will, if we do this. And it's important to know that. It's not going to come free. It definitely comes at a cost. Second thing we can do is amend Rule 10b-18 to increase oversight and reporting requirements. And what that might mean is we don't allow executives to blatantly do this to make themselves more money, to blatantly do this to make their earnings per share look better, to blatantly do this to hit their targets. We put some sort of requirement in there. The reporting requirements and the oversight in 10b-18 aren't good. That's one of the big criticisms people have of it, including myself. So maybe we can change that. However, I don't know that really impacts them, because we need these companies investing. We need them taking their money and putting it not in, these sort of meaningless financial transactions, but back into the economy, growing their business so people have more economic opportunities for employment and things like that. Another idea that I saw that I kind of liked was to allow shareholders to vote on share buybacks, meaning the company would have to disclose to other people who own its company, or own the company stock, including the people that they'd be buying it back from, that they were interested in doing that. And the shareholders would have a right to say yes or no. Now, I think that's an interesting idea, but I don't know that it really solves the problem either. We would definitely be empowering shareholders to have a say in this, and it might dissuade executives from being so brazen, and it might put a stop to some of this, because they obviously don't want to anger their shareholders by doing this. It's if you buy back from your shareholders, you're again expecting the stock to go up, so the people that sell the stock to you are going to end up losing, and therefore they might say, well, forget it, we're not going to do this anymore. And we're not going to do this because we know we're going to be on the losing end, unless we get on board and have you buy back the stock. But you're going to buy it back at a rate, and it's going to go up, a couple days later. So, or actually almost immediately. So that's one way that we can possibly put a check on it. My own view, and again, I welcome your comments and your thoughts below on any of this. My own view is that we should make them illegal again. And again, illegal in quotes. We should take away the safe harbor protection. Because I think if we do that, number one, we would take away the sugar high that some of these companies have been on. They would have to then really think about what to do with their capital. They'd be down to just the three choices. And really at that point, 3 would look the best. It'd be risky, no doubt. But you really get nothing out of putting it in the bank. You'd get nothing out of paying off debt because they've been borrowing at zero for months, if not years now. So really the only place for the capital would be in investment, in R&D, in new products, new services, the things that we want them to do. So that's my own view. I think that we should make them illegal again, but I do recognize that it will come at a cost. It will hurt everyone's 401k. It will cause, a ripple effect throughout the economy. There's no doubt of that. But I think the benefits outweigh the risk. That's it for today. Thank you so much for watching this video. As always, it's my pleasure to talk to you. Like, comment, share, and subscribe. Share this video with a friend if you thought it interesting. If you saw something in here that you think I got wrong, that you think is inaccurate, comment. Let me know. Let's grow together. Let's get a good debate and a good conversation going. Thank you all so much again for listening. Until later, God bless.